Nuestra siguiente conferencia se titula Invirtiendo a lo largo de la vida de un afiliado y está a cargo de Martyn James, Wealth Leader para América Latina y que cuenta con más de 20 años de experiencia en asesoramiento en inversiones de largo plazo, particularmente de fondos de pensiones alrededor del mundo. Esta conferencia es en inglés. Recuerden que pueden acceder a ella en el botón que dice Traducción en el lado derecho de la pantalla. Señor James, bienvenido, welcome, adelante.
Hello, good morning everyone. My name is Martyn James. I'm the Mercer Wealth Leader for Latin America. It's a great pleasure to be with you, talking to you this morning. I've been in Latin America, living in Mexico City since the start of the year, but I've been working for Mercer for 19 years, mainly in London, but also a short time in Melbourne, Australia. Hopefully what I can bring to you today is a global perspective on designing a defined contribution pension scheme system. My background is as an investment consultant to that type of pension scheme. For those of you that don't know Mercer too well, here's just a couple of statistics for our credentials this morning. We've been advising clients on defined contribution pension schemes for over 37 years. And as we speak today, in total, our clients represent 880 billion US dollars of assets. We don't just advise pension schemes, we do also manage our own defined contribution pension schemes. And in total, we manage over 55 billion US dollars of assets, including a very large Australian master trust, which is about 25 billion, and a large and growing UK master trust, which I have been involved in. So on with the presentation. So first of all, when we're advising clients or we're implementing our pension schemes, we need to have the individuals at the heart of everything that we do. And there's some real basic things at the start which are required for a good pension scheme system. You know, the three are detailed on this page. Of course, it's absolutely vital that enough contributions and savings go into the system. Once the people are saving and people are saving enough, then it's the investment return on top of that, which is extremely important. And in fact, if you were to do the calculations, if someone contributes right the way from the start of their working career, the investment return that they could achieve on top of their savings probably contributes about as much to retirement income as the savings themselves. The third pillar to this is effective engagement and guidance. Of course, in your system, contributions are mandatory in the workforce, but people can contribute extra, and it's very important they're engaged with their pension scheme system. Yeah, this framework is no different in Colombia. I'm going to concentrate today on the investment side of things, but the whole piece of the puzzle is vitally important. So continuing the theme of the individual is the heart of everything. It's got to be at the heart of the investment design. So here on this page, what we've shown is that you can, we believe, split an individual into three stages of their life cycle. When they join the organization or they join a workforce, maybe in their early 20s, late teens, they will start saving and start in the accumulation phase. And that is probably the longest phase of the cycle, and we'll go right up to just a few years before retirement. It's vitally important at this time that contributions go in, but then we're trying to maximize the investment return on those investments, looking for really high growth. And we can withstand volatility and potentially market falls at this stage because the contributions and the savings will continue, and hopefully the markets will revert. The retirement stage in the middle here, probably starts 5 to 10 years before retirement. So maybe at the age of 50, 55 years old. At this time, we need to think about the fact that individuals will be retiring soon. They'll be stopping contributing into the pension system. And actually, there's less time to make up any market losses. So at this time, we need to think about de-risking. We need to think about diversification, and we need to start preparing people for what they're going to do in retirement. And this is the final stage, the deaccumulation phase on the right-hand side. This is effectively how people take their income in retirement. And that can be drawing down their pot over time as and when they need the money, or it could be some kind of guaranteed income in retirement. And actually, the retirement phase in the middle, individuals will need to be preparing for how they take the income in retirement. I'm going to talk about each of these phases and how we think about designing the investments in each of these, but the individual is at the heart. I'm going to spend most of the time on the accumulation phase. So as I've said, this is the stage where individuals really should be trying to maximize the return that they achieve on their savings, a long way away from retirement. And of course, if you were to go back through history of investments, the best performing investment asset class is equities. So there is an argument to start with that the accumulation phase could be all or could have a very high weighting to equity investment. Equities over historical times have achieved something broadly of cash plus 4 or 5% per annum, but of course that return has been volatile. And the reason that we don't advise clients just to invest in equity is that we believe that we can achieve an equity-like return, so that cash plus 4 to 5% return with lower volatility by diversifying and investing in other asset classes. And I think it is important that pension systems try to manage that volatility or lower that volatility because you want to have trust in the system. You don't want people worrying that they're not going to get their money in retirement because of large market falls, for instance. And you want people to continue saving and not to worry that their money is being lost. So we start with an equity-like investment, and then we think about diversification. I'm sure that many of you know about diversification. The father of modern portfolio theory, Harry Markowitz, made the quote that diversity is the only free lunch in finance. Effectively, what we're talking about here is not putting all of your eggs in one basket. You're having not just equities, but you're using other asset classes to smooth the return, other asset classes that might perform differently or better in times of market stress and might smooth that ride for investors. So here is a diagram of what I mean about smoothing the return and why it's important in the accumulation phase to have the diversification. If you were to look at if you see here the dotted line going up, if we were to call that our equity return or our cash plus 4 to 5% return, whatever you're calling the target for the accumulation phase, there are different paths of getting there. Let's just say you could get there by just investing in equity, maybe just investing in Colombian equity. You might experience something like the dark blue line with its peaks and troughs. And of course, if we have a period like 2008 and 2009, you get a big panic and a big trough in investment returns. But of course, that can recover as it has and lead the way to your target in the long run. But what if you could achieve that same return by following the grey line, by investing in other asset classes to smooth the return? Of course, I think all of you would agree that you would choose the grey line. And we believe that it's possible to create a diversified portfolio, which is far more robust to follow a grey line rather than the blue line. My intention is not to get technical at all in this presentation, but there is a range of different investment portfolios that you can choose with a range of different risk and return characteristics. And what you should try to do is to maximize the level of return per level of risk. And different portfolios can fall in different areas below this blue line. But what you want to try to do as an investor in the accumulation phase is get to the blue line as close as possible. So let's say you start with a simple portfolio on the bottom right-hand side here. Let's say that's 60% equities, 40% some kind of growth fixed income. What you might try to do is to try to keep the same level of risk, which is on the bottom axis volatility, and achieve a higher return if you can. Or you might decide that that return is okay, and you can try to achieve that return with lower risk. Of course, what I'm saying in the accumulation phase is you're trying to get a high return, but you're trying to get it with lower risk. In the pension schemes that we manage around the world, so the UK Master Trust that I mentioned, that I have been involved in, we have a target to deliver equities over a market cycle, so that might be 8 years, but with lower volatility. And we've got an explicit target of targeting 2/3 of the volatility of the equity markets, to give you an idea of what we're trying to achieve. Here is a complicated, diversified portfolio. Not putting on this page to scare you. This isn't a portfolio that has been put into practice. We call this a reference portfolio. So if we're starting with a blank sheet of paper, this is a portfolio that would be very well diversified into different asset classes to achieve that equity-like return with lower volatility. So that the asset allocation, you can see, does have a large allocation to equities in the blue here, but also to equities that are private as well, and I'll come on to that a bit later. We have other growth asset classes in terms of real assets, so real estate, private debt and infrastructure. And we also have some growth asset classes on the bottom left of the pie, so emerging market debt, high yield, multi-asset credit, etc. And actually, we do have some defensive assets in here as well to manage the volatility. But we believe this would give a good level of return for a defined contribution investor. What we do is we use this as a base where colleagues from around the world can use this to help clients or to implement their own pension schemes and improved asset allocation. So I'm going to talk about some of these pension schemes now, the Australian, the UK and the US. They'll take this as a starting point, but as you will see, they have some differences, and the differences will come based upon tax reasons, historical reasons, cultural reasons, and many of the reasons that you'll have in your system to come up with something different. But the point is that diversification can work and can improve that journey for individuals as they invest through their lifetime. The consistent themes across as we use this reference portfolio, I've mentioned diversification. The other piece is open architecture, and we'll come on to the implementation piece in a moment. But each of these pieces should be implemented using the best managers from around the world. There is no way that we would be advising using the same investment manager across asset classes, very much trying to find the best managers from around the world to manage the allocations. When we talk about dynamic asset allocation, we're talking about using the strategic allocation that you have and considering the market environment by changing it. So markets get dislocated, and over shorter time periods, maybe from a 1 to 3 year period, there may be opportunities to tilt your portfolio in certain areas. And I think this year, in the time of COVID, there have been market opportunities to do just that. And the final piece that I will be talking about today as well is the environmental, social and governance aspects, or ESG, which we believe is an important overlay given some of the risks that exist that are not picked up in traditional models. So just to make a few points about some of the pension schemes from around the world. Let's start with the UK. I think it's a good starting point because actually there is no home bias in the UK portfolio, and this is the one in the middle. This is the one that we have for our own pension scheme. The UK allocation in it is related to the UK exposure in the market index, which is about 8%. You can see in the blue, this is the equity allocation, so it represents about half of the portfolio. And then we go into things such as property, infrastructure, and some of those growth fixed income asset classes that I mentioned, such as high yield and emerging market debt. This portfolio is very liquid and has very low fees, which is a big driver in the UK market. So actually, these are all passively managed, and something like the infrastructure is listed infrastructure rather than owning the physical assets. Which links into Australia, which is on the left-hand side. The Australian defined contribution market is relatively mature compared to most around the world. The system's been going since the mid-1990s. And if you look at our pension scheme that we manage, you can see it is the most diversified of the three on this page. Yes, it still has a large allocation to equities, in this case, 60%. And you'll see down the bottom that there is a heavy home bias towards Australian equities. And that's due to tax reasons. There is a tax benefit to holding Australian shares over international shares. And actually there is a cultural bias to wanting to hold Australian stocks as well. If we go up into the kind of reddish, into the green colors, this is the infrastructure and the property. In this case, they do hold the physical unlisted property and infrastructure. That's how we would do it from a blank sheet of paper. We believe that there's a chance for increased return and better diversification. Fees are less of a driver here, and the risk-adjusted return is more of a driver in the Australian market. Moving to the US, piece on the left-hand side, you can see it's much simpler in design, but still follows many of the principles, a large allocation to equities, but look into real assets and bonds as a form of diversification. Just to say that currency exposure is important. There's a lot of international assets on this particular page. These portfolios have a portion of currency hedged around 50%. That may be different for your local markets. You might find that currency is a very good diversifier in itself, and we certainly believe that in times of stress, that some of these international currencies, especially the US dollar, can provide a hedge in downward falling markets. So on to the Colombian asset allocation, probably looking at the high risk one on the right hand side to be comparable. You can see that I think that the AFP market in Colombia is following a lot of the principles in terms of a high equity allocation. I would point out, first of all, the home bias, which I'm sure you're all aware of. The Colombian market makes up a small proportion of the global market, and actually this portfolio is about 46% overweight its market cap. Why is that important? Well, I understand that the top 10 top largest companies in the Colombian index make up 82% of the index. So this means that there is a lot of concentration in these portfolios, certainly by company, probably by sector as well, and probably by return drivers. And so that chart, which I showed on the previous slide, which showed the pathway to achieving your cash +4, cash +5% return, you could be more volatile because of the exposure to the concentration of the Colombian market. I would say on this page as well, there's probably less diversification into things such as growth fixed income, and maybe not as much diversification as something like the Australian market into private markets, which we believe is very important as well. But many of the same principles that apply to the other portfolios should be used in the Colombian markets, and indeed it looks like there are some principles used in here as well. Just to mention on private markets, Private markets includes private equity, infrastructure, private debt, some sustainable private investments. Here the slide says private equity, and that's where the Colombian market seems to be invested most. But I think that a good diversification across private markets is important as well. There is, of course, the illiquidity premium that you can receive from these types of assets. And I think the AFP market and defined contribution schemes in general should be holders of these assets because they are long-term investors, and individuals investing over a long time frame can withstand some illiquidity in the portfolio and can go after these stronger returns. Private equity, for instance, just pulling out a couple on this page, some of the investments that you can make in private equity, you get exposure to companies which are very innovative, that maybe are on the earlier stage of their growth potential. You get exposure to some different sectors in the private market sector. And of course, the ownership that you would be getting from them means you can have influence in the companies and a bit more transparency in your investments. Just going to skip this slide for a moment. Just this slide just shows the increased opportunity set that you can invest by investing in private equities. This is the US market, but if you look at the public companies on the bottom, on the left-hand side, you can see it's really dwarfed by the number of private companies that are in that you could possibly invest with by expanding this portfolio, which just shows the expanded opportunity set that you might be missing if you're not in this part of the portfolio. Just going back onto this slide here, this is the return of different asset classes over the last 10 years or so. It's a very complicated chart, but it just shows that different asset classes perform in different levels each year, which just another point on the diversification benefits of having different asset classes in your portfolio. If you look at the right-hand side, over the peaks and troughs, you can see that private equity has been the highest performing asset class over this particular time frame. If I could just move on now to implementation. Just a point, first of all, that what I've spoken about so far is designing the strategic asset allocation. So how much you have in each asset class and making sure it's well diversified. This is going to be the most important decision that a retirement system or a pension plan makes. It's going to drive 90% of the returns. And you could argue that it should take up 90%, therefore, of your time and your efforts when you run these pension schemes. However, once you've designed the strategic asset allocation, you need to find investment managers to manage those asset allocations. And it's important that you find robust managers and the best performing managers to add that extra return for the individuals. But it's not easy. It's a process that takes skill to find the best managers. It takes a lot of time, and it will take manpower to do it. As an organization, we have spent many years refining a process to select managers, and it's part of our process to select the best managers from around the world. We have over 200 researchers across the globe looking for the best managers across all the asset classes that I've mentioned in this portfolio. And we have a consistent process for doing that. I don't have time today to go into the process, but there is a funnel on the left-hand side, which we go through, which starts off at over 36,000 strategies. And we filter that down so that we have a view on nearly 12,000 strategies across the world. And actually, 56% of them are rated A, B plus, or B, giving our clients an investable universe to choose from. We have our researchers go in to look, to visit the managers, to make sure they're getting a forward-looking view on how a manager might perform in the past, which is very different to a lot of organizations such as Morningstar, which use past data. we're really looking at the things on the top right-hand side there: idea generation, the skill of the investment manager, the risk management when they're putting together portfolio construction, implementation, how they buy and sell stocks without leakage in performance, and how strong the firm is generally. And it includes things such as remuneration structure of the investment managers. We advise our clients on selecting managers, but of course, with the complexity that this brings, and again, if I go back to that 90-10 kind of rule, that this isn't as important as strategic asset allocation, many clients around the world delegate to us for the investment manager decision as well. I'm actually going to talk about ESG next, and I'll cover this, but it's just to say our manager process as well. We do research and have a view on our managers of whether the managers that we research take into account those environmental, social, and governance aspects and the risks that companies face in those areas when we're researching. And we have a scoring system of 1 to 4 on this as well, which is 1 being that it's fully integrated into the process, and 4, little or no integration. Now, just coming on to ESG as part of the process of designing the accumulation phase. This has been a hot topic for a number of years. We've been looking at this for our clients since 2004, but it seems that each year it gets more and more focus and intention. And it's great to see across Latin America that it's getting a lot of attention as well, and from you in Colombia. When we've spoken about some of the diversification pieces, earlier on in this presentation, we're really looking at very traditional measures of risk, volatility. Many of you will look at other elements of risk, such as VAR, value at risk, or conditional VAR. There are many risks that need to be considered when designing a portfolio. There are many risks, I believe, in a portfolio related to environmental, social, and governance factors that need to be considered. If we take the environmental piece, first of all, you may be aware that the EU and China, and actually the new Biden administration, have all given a commitment to get to carbon neutral by the middle of this century. That's 3 huge global economies that are moving in that direction. And the way that they're going to do this is through legislation and regulations, which are going to impact companies. So we have to consider, whatever your views on climate change, that a carbon transformation in this way will have impacts on companies and will introduce risks to companies as well. If I talk about the social risk very, very briefly, actually there is a quote from 1970, Milton Friedman, preeminent economists, that there is one and only one social responsibility of business: to increase its profits. I think that is very much being challenged these days, in terms that companies should be run for other stakeholders as well, should be run for employees, should be run for their customers, and above all should be run for society and communities as well. And if we think about the current situation of COVID crisis, where government support around the world for companies, things such as furlough schemes, providing financial support, central banks lowering interest rates, I think if companies continue with just the focus on increasing its profits and maybe borrowing to increase dividends or share buybacks, then I think that would be taken very negatively by governments and by regulators, and again, maybe highlights a risk to companies if they don't take action. So really what this kind of comes onto is on this page is, I think that the one reason you should consider ESG is the risk element of not doing it. So that's in your strategic asset allocation, maybe your exposure to carbon in your strategic asset allocation, but how your investment managers are looking at stocks as well. There is a return aspect. There is an opportunity here to maybe invest in emerging technologies such as renewable energy, or maybe companies that have a thematic account of water scarcity, or maybe green finance. And I think finally, it's important to recognize the reputational aspect here. You are, after all, managing money on behalf of the individuals in your population, and they will increasingly demand that their investments are responsible. And an AFP that is not doing that compared to another one, there may be a certain reputational risk to consider as well. Of course, it's extremely important in Mercer. It's one of our 5 investment beliefs, and we take it into account on all the advice that we provide our clients and the investments that we made. I'm not going to focus particularly on this slide. The environmental, social and corporate concerns, there's a few listed on this page. I didn't cover the governance ones, but things such as executive remuneration is a bigger focus around the world. Board structure in terms of diversity, gender representation on the board, and audit quality are important risks to consider as well in your portfolio, and will only increase over coming years, I'm sure. You're probably underway of finding a way to make these part of your portfolios. There's a pathway that we help clients on, starting with their beliefs, and that will translate into their policies, and then integrate it into the process into your portfolios. This isn't something that you can do in a matter of weeks or months. This is probably a process which will take a few years to integrate, and there are ways that you can go on a sensible way on this pathway. Once you're into the portfolio, I'm just going to very briefly highlight the 4 ways that you could to make this part of your portfolio. The first one is integration. Make it a part of your investment processes. So when you're selecting investment managers, all else being equal, you could select investment managers that have this very much part of their process. This is where our ratings that I mentioned before can be helpful to clients. There are ways that you can measure the carbon footprint of your portfolio or your exposure to climate change, and you can be on a pathway to reduce this over time. And we do that kind of analysis for clients as well. The second one is investments. You're maybe allocating 10-20% of your equity portfolio to sustainable themes such as renewable energy or water scarcity, as I mentioned. That could be a return generator, as well as managing the risk of the overall portfolio, and that's becoming very popular on a global basis. Stewardship is actually the third one, very interesting and maybe very applicable for you in the Colombian market. You own a lot of the AFP markets, own a lot of the local companies, and do have a lot of influence in terms of control. And so stewardship effectively means you're taking seriously that ownership and voting according to the beliefs that you've had. So it's maybe voting on climate change issues, maybe voting on governance issues such as executive remuneration is something that AFPs can be very powerful on. And we've helped clients around the world making sure that they are a responsible owner of assets and making sure that they are voting. The final one is about screening. It's if you have a belief that you maybe don't invest in certain assets, certainly that when we manage portfolios, we don't invest in controversial weapons such as cluster bombs. Actually, we don't actually invest in tobacco these days either. We prefer some of the other ones. We prefer to invest in companies and to impact their change. So we will invest in oil companies, for example, even with a climate change belief, but we will try to engage those companies to lower their carbon footprint over time. Moving on in the interest of time, that's a lot to cover on the accumulation phase, which is the majority of my presentation. But the retirement phase, if you recall, this is when people are becoming closer to retirement. They are going to stop contributing in a few years' time. they will not have as much time to recoup any losses. And this is where you probably need to start to think about de-risking the portfolio. And in the portfolios that we manage, and certainly in the UK, we start to de-risk about 8 years before retirement. We feel that's a good balance. You don't want to de-risk too early because you'll impact the return and the amount that you accumulate for your members. But you don't want to de-risk too late, which could really damage their portfolio if there is a strong market crash. So we start to de-risk 8 years before retirement, and you can see how those coloured lines start changing. The other important aspect here is, what do you de-risk to? And this will depend upon how people will take their retirement income. So will they be drawing down the income over time in retirement, or will they be having some kind of guaranteed income through maybe an annuity through an insurer, etc. In this UK glide path, people tend to draw down these days, and I'll come on to this in a bit more detail in a moment. So we're de-risking to about 50% in those growth assets, trying to achieve that equity-like return still, and 50% into more defensive assets as well. I think it's very important with the whole design here is that this is a glide path over time, trying to have the member at heart with their specific needs at different ages. You could implement this in a life cycle approach. Some countries have implemented this into a target date fund approach, and certainly Mexico has undertaken recently in their Afores market this approach. But it's trying to think about what are the risks and the needs for members at different ages, and having that mechanism to change investments over time is important and is a consistent approach across the world. This is the Australian glide path. It's the same, very similar to the UK. You can see that somebody that is young is invested 89% in growth assets and 11% in defensive assets, as I showed on a previous slide. And by the time they get close to retirement, it's more 50-50. Again, in the Australian market, people tend to stay invested and draw down their investments over time. Once people go into retirement, and as I said, we call this the accumulation phase, there are different ways that they can do it. But again, we try and think about the individual first of all when we're thinking about the design. This is people's needs in retirement. And if we look below the dotted line, below the dotted line here, people will need essentials in retirement, and that is the most important that they receive. That's what you need to have adequate in retirement and sustainable in retirement, making sure that they can feed themselves, they have access to healthcare, housing, clothing, and energy, etc. And for that piece, it would be great if you could secure their income over time, maybe by way of an annuity. In many countries, this is where a state benefit, a minimum state benefit, comes in to cover the essentials. Or if you're investing through an AFP system, for example, probably investing in defensive assets to protect that over time. And people shouldn't really draw from this over time to make sure that this lasts until they were to pass away. The piece above the line, which may be a larger portion of assets for some people, are for more for luxuries. Maybe things people want to do in retirement: travel, hobbies, new car, or even people might want to leave some of their money from the retirement system if they were to pass away early. It potentially can take a bit more risk with this. Maybe just through the pre-retirement stage is not enough, and you need to keep investing for people to achieve these particular needs. So the way that you can be invested in retirement for this, there's the investment-based approach. This is where people stay invested, and of course it could look very similar in AFP system to the pre-retirement stage, the same kind of investments, but just with lower risk. But there are many different strategies that you can see on this particular page. Your tax-focused strategies, manage volatility strategies, managing tail hedging risks could be in the portfolio. Guaranteed based, there are annuities through an insurance company. There can either be term annuities which start at a certain age. Certainly the US and Canada have gone down an approach where the annuities kick in when people are a little bit earlier, deferred annuities, maybe when they're into their 80s, or there can be annuities that last for the lifetime. Some new innovative approaches have come in, such as longevity pooling, which isn't through an insurance product, but by pooling individuals, you can pool the risk to give them that guaranteed type return. My final point in the presentation, just on this, is that just an experience in the UK market is quite interesting. Before 2015, the tax system in the UK was such that people were effectively compelled to purchase an annuity. So they had that guaranteed income for life. The government at the time, the Conservative government, didn't like that approach. They thought that people weren't getting attractive income in retirement. They weren't shopping around getting good deals, and they just generally liked the philosophy of freedom and choice, which is actually what they called it when they changed the law into 2015 to change the tax system to allow people to be able to take income as they liked in retirement to stay invested. Indeed, they could take cash totally on day one if they chose. And what has happened over this time, there's a bit of data on this page, is that you can see that very few people take annuities these days in the UK or take that guaranteed income for life. Most people withdraw it and either take it as cash if they've got small pots at the top, or draw it down over time. So it's just to be aware that you might like people to take some kind of guaranteed income in retirement. And in the UK, it's more down to the government to provide that as a state benefit. But if you do give people the choice, they're likely to stay invested. And this is probably where the AFP system, comes in, where you can keep people invested over time, managing well their investments, trying to protect the essentials, but trying to help them grow the portfolio over time as well. I think I'm exactly on time there. I hope I've not gone through that too much. There's a lot to cover when you're talking about the life cycle of an individual over time and the investments to consider. But hopefully that gives you a flavour about how we think about things at Mercer, how we have the individual at the heart of everything that we do when we design robust portfolios. And hopefully you can take some of this thinking into the rest of your conference and also into your daily thinking. Thank you.